When I hear that Trump didn't pay tax, I was not surprised. Because avoiding tax is a basic skill that any self-respect accountant can perform. The question you should be asking yourself is not how did Trump avoid paying tax, but how can you avoid paying tax? Because overpaying tax is a loser strategy. Now go grab a paper, cause I'm gonna teach you how can you dodge taxes. The strategy I'm gonna teach you is applicable anywhere in the world, because the formula are almost the same. I'm saying that as someone that speaks 3 different languages and I know at least 4 different accounting systems. I guarantee you the formula are almost the same. Despite of that, you must be careful, because sometimes the government office or the government tax office is made of competent people. As I said, sometimes, which means the other times, most of the time, the people gonna verify your tax report are incompetent people who love the comfort, are too afraid of innovation, let alone compete in the real world or the free market. But that is not the only variable in your favor. If you don't know, our politicians are financed by the rich people, and the rich people don't put their money where there's no return. Most of the time, the relationship between rich people and politicians is a quid pro quo relationship. In other words, I give you money and you give me benefit, gold in my hand and bird fly in other hand. Now let's learn how you can avoid tax and make more money. Let's start with the basic, with the universal formula. The government taxes your profit and not your revenue. Profit is equal revenue minus expense. Expenses are the costs involved in the creation of the final good or service. Usually, the expenses are deducted on the income generated from the sale of the final good or service. Whatever left over from that deduction is called profit. And there are 2 ways you can make more profit. 1, by increasing the revenue, and 2, by decreasing the final profit. I think you got confused by the last one, and that's where the trick is. When I say you can make more money by reducing your profit, I'm talking about increasing the expenses, add more debt instead of equity or cash, pay your patent, and most important, use subsidiary or parent company to reduce your revenue. Let's start with the expenses. Expenses are not just costs, they are also tax write-off. If you register some of your activities under your business, you can always use those activities as a tax write-off. Example, if your car is registered under your business, whenever you drive it, it is a write-off. Maintenance is a write-off. Some country tax law stated that you can only write off your travel expenses or transportation expenses when the expenses is related to your revenue or to your business activity. This principle is applicable to almost everything, from car expenses to accommodation expenses. But the question is, how do they know? How do they know that your car expenses are not business expenses? How do they know that your head on the Bahamas it's not a business expenses? There's no way they can find that out unless you raise too much suspicion. So move without making noise. Move quiet. Don't raise eyeballs. Carry on. You can hire your children and then send them to college, and that will be a training expenses, not only but also a tax write-off. But you don't have to stop there. You can rent your own house for your business activity. At the end of each month, you pay rent to your own self and call it a write-off. But you might be at risk of paying tax for your rental income. But what if I say you can avoid that? Let me introduce you to a new friend. Its name is debit. In finance class, we learned that your company can raise money through debit or equity. So debit is a finance tool. Remember, it's 21st century. There's no shame in using debit to finance your activities or to avoid taxes. It is a tool, so you must be smart. Don't get into debit for dumb reason. Be smart. Anyway, carry on. That rental income that we talked before, you might use to pay your mortgage. In case you're still afraid of paying tax, well, maybe that debit you acquire from a company located in a financial paradise like the Bahamas with zero income tax. And most likely, you own that company and you are paying mortgage to yourself. But that's between me and you. No one have to know, so stay quiet. That's not the only way to use debit to reduce your taxes. There's a less shady way of using debit without feel guilty, and it's actually legal, like legal. Let me introduce you to my new friend. It's an old friend, but it's a new friend for you. Interest expenses. You can use interest expenses to reduce your company tax because the interest generated by debit is tax deductible. This type of interest is also known as interest tax shield. Repeat, interest tax shield. One small or big detail, you must know what you're doing because this type of strategy might end up really bad if you don't know how to use debit. So let's leave debit for a while. Let's go to patent and parent companies. Let's start with the basic by start giving the definition. If you want to use a patent or a trademark that's not owned by your company, you must reach an agreement with the part that owns the trademark and the patent. And most likely, your company will have to pay a fee, or most likely all revenue generated by the patent or trademark. Now, let's define parent company and subsidiary. A company can have multiple companies under its umbrella. Those companies are called subsidiary, and the companies above is the parent company, especially if that company owns all the shares of the companies under the umbrella. Now that we got the basic out of the window, let's start with the shade strategies and the shenanigans. You can register your company in a financial paradise like Ireland, the Caribbean, or the seat of London. It's not London, it's the seat of London. It's in London. With a parent company in a financial paradise, you register all the patents and trademark under the parent company, so that every time you sell a product related to the patent, you will have to send a percentage of the revenue, not a profit, revenue. You send a part of the revenue to the parent company because that patent is an expense that your company needs, and without that patent, your business cannot make a product or offer a service. Basically, your parent company will be the main company, and the subsidiary will be like a distributor, even though you carry most of your business in the subsidiary. That is what most of the big companies did, especially the tech companies. Example, a tech company is owned by an international company that's registered outside of the US, most likely in a financial paradise. So the tech company will have to pay the international company for all the revenue generated by those patents and trademark, which is basically everything. I suspect that, that big search engine company that I cannot mention the name because conflict of interest. But let's just say that big search engine company is structured in this way. And even if you look at their executive, the guy that is the CEO is not really the CEO, because in the board member have that company, the parent company that has a name that we learn in the primary school, but I cannot mention the name of that company. Anyway, I think you got what I mean. Anyway, those are just some tricks, and there's more. And believe me, your politicians don't care about rich people hide their money, because some of them are even doing the same. I don't buy that the politicians in the West are not overpaid. I suspect they are overpaid, but you don't see that because they know where to hide. But that's just my opinion.